it's not going to be writing 30, 40, 50 projects a year. You may only write 10 or 15 projects a year, but they have to understand that those projects are going to be well underwritten and hopefully well managed, both from the insured side, from the carrier side. We just can't go back to the hazy, crazy days of the mid 2000s.
Welcome to Talk to Me About A&E, a podcast series focused on risk management for architects and engineers. Host Dan Buelow, Managing Director of Willis A&E, will engage experts across the A&E spectrum on topics ranging from contract details to the broadest trends impacting design professionals in North America.
Hello and welcome to Talk to Me About A&E. I'm Dan Buelow, and our topic today is on insuring single projects. This is part 2 of my discussion with Ryan Brennan of HDI. So Ryan, I mentioned that, the owners will often pay for this coverage because there's a real benefit, and some of the benefits to the owners from an owner's perspective, right? And we kind of went through some of the features and what have you, but one of them is control. You as an owner select the appropriate limits for your design team rather than relying on the individual practice policies. And again, if you have a very large project, you might have quite a range of design professionals on that project, some of them with limits as low as $1 million or so, are certainly not adequate for some projects. So control is a big factor, isn't it?
Absolutely. And what I had always suggested to my potential insurers on this, when they're looking at a large project to bid on it, I would have them go out and request indicated pricing for what a project policy may cost. And I would include that within their bid into the project. It's always more challenging. We found that when firms have gotten a project and then the owners decide that they want a project-specific policy, and you go back to the owner after he's been given this bill for this new construction project to see an additional large bill for the insurance coverage. So it's always easier to include it in your bid and then not have to try to negotiate it after the fact. So, As I said, sometimes we'll see the owners will agree to pay for it up front, and they'll pay the lead firm the premium and then pass it on to us. Sometimes they'll pay it to us directly, which is very rare. As I said, inevitably, they're always going to be responsible for the payment of the premium, whether they pay it direct, indirect, or through the overall cost of the project with the cost of the insurance built into it.
Right. And other features and benefits of this coverage from an owner's perspective, again, is you're covering the entire design team. Again, it's those limits. You might, again, have smaller firms with lower limits, but also that there's guaranteed coverage here. Again, as long as you're paying that premium, that rate is guaranteed, and that premium is guaranteed. It could be auditable if there's a additional premium due, if there's a material change, if you will, or variation in the actual risk that was underwritten. But guaranteed is another benefit that this cost is and this coverage is in place. Unlike, again, that specific job excess, which is subject to renewal every year.
Exactly. Plus, as we're seeing more and more, especially on the public works projects where you have minority-owned business requirements, women-owned business requirements, veteran-owned business requirements, it allows you to bring those groups into your bid process much easier because you're going to be providing the limits of insurance that are required that these firms typically would not carry, as you said.
Right. And again, there's dedicated limit for your project as the owner. If you don't have a project policy, you're going to be looking to the individual practice policies of all the design team, of which none of those limits are dedicated to your specific project. So all good points. And then last but not least, and again, I think it's arguably one of the most important features and benefits of this product is the joint defense provision, right?
Absolutely. Absolutely. It's always better. The owner would always be most appreciative by just having to go to one source for any issues that he has rather than trying to hunt down, 15 or 20 different consultants that may or may not be involved.
You'll see quite a range of limits with different consultants. As I mentioned, the smaller firms are going to have, $1 million, maybe $2 million of practice limits, and the larger ones are going to have 5, 10, 20, 100 million. It depends on the firm and their area of focus and so on. I think it's important for both the design professional and the owner to consider a project-specific policy for any project with 100 million and greater in construction value. And I just kind of use that as a number where I think it's important to have discussions about the unique nature of that project, because anything that starts getting to that level, it's going to be more complex. It's going to usually take a longer period of time to complete, multiple disciplines and so on. And so I think it's at least important to be considering having a project-specific policy versus relying on the practice policy. Do you have a minimum, Ryan, that you'll consider?
Well, yes, I personally prefer to limit it to 100 million and above. And again, we have been requested to look at these smaller projects under 100 million. And quite frankly, I've just struggled trying to find the balance between what would be an adequate premium, what would be an adequate retention that would really make it affordable to insure those smaller projects. And I personally have not been able to find that balance. There may be some markets out there that have, but if it is, I think it's few and far between.
Yeah, I would agree. Which segues nice to my next question for you. So what is an area that design professional firms should be mindful of when entering in projects that seems to be outside the normal purview?
Some of the areas, when you're talking about the areas they should be concerned with, obviously, the number one concern with anybody is when you're going into these projects is who are you going to be working with? Is the owner someone you have done business with before? If it's not a new owner, what's their reputation? Have they done this type of project in the past? That opens up a whole series of questions that the internal firms have to address amongst themselves. The other area that you want to look into is who is the contractor that you're going to be working with? Is it going to be someone, again, that maybe you've worked with in the past? What is their reputation in the marketplace? How have they treated other design professionals in the past? Has it been a good working relationship? What's their record as far as finishing projects on schedule, on budget? Which is always very important, especially from a design standpoint, because if they have had issues in doing that in the past, they're typically going to then point the finger that it's the design that led to the project getting lengthened and not completed on time and on budget, because there were some complexities or issues with the design that the contractor didn't foresee.
Again, the quality of those relationships and partnerships are so important. Talk to us about the various project delivery methods that you're considering and seeing as an underwriter when it comes to this particular product.
Oh, absolutely. So there's a few different types of project deliveries that we've seen. We've seen starting out with the design bid build, whereby the owner contracts a design firm to say they want to build a hospital. So they'll have the designer put together the nice, pretty drawings for the hospital and then start to do the initial blueprints. And once that's done and the owner's satisfied with it, then they'll put that out to bid. So the contractor, typically the design will be very largely percentage-wise completed, hopefully, and therefore the builder then has a good set of blueprints in which to base their pricing on. The other type of delivery system we've seen is what's called design build, which, as the name implies, it's set up to be a partnership between the designer and the contractor to work together jointly so again, say the owner wants to build, a hospital, they would go to a design build team where the builder and the designer work jointly together to price out the project and then work through it from start to finish. And the owner therefore has the contract with the design builder as compared to the design bid builder, where he has a contract with the designer and a separate contract with the builder. Typically, that structure we have seen is that the builder is typically the one in charge, and then they have a separate contract with the designer, but yet it's still approached to the project owner as a design build. We've also seen what we call P3, which is basically a public-private partnership. And we've seen that a lot with municipalities that say, do not have the money, say, to construct a new bridge that's needed. So they'll go to the private sector to get the funding for that, including that would be the contractor and, say, the designer. And they'd say, so what they do is they say, you bring us the money, we'll let you build it, we'll let you set it up as a toll road, and then you get paid a percentage of the tolls that are collected from this. That was a hot way of pursuing it for the last few years. I think it's reared its head as far as difficulties it's created, in that the ultimate target monies that may have been received from the public-private partnership hasn't always met expectations. And then, of course, now what we're seeing more of, which from an underwriting standpoint we really like, it's called what we call a progressive design build. And what this is that the designer and the contractor are working together. And as the design is being put together and reviewed and approved by the owner, the builder will come in and he'll say, all right, based upon what you want to build, here's your initial price on this. And that may have been based upon, say, 30% design. But this number will be subject to change as the design gets closer to 60, 70, 80% complete. The owner agrees to that. And then as they're working through the design with the builder and hopefully with their lead subcontractors, the builder is then able to get a better handle on what his actual costs will be. So that, say, once it reaches 60, 70% design, he should then be able to go back to the owner and say, okay, in working with the designer through the transition of the design from 30% up to its present state, we now know the project is going to cost us X more dollars. The owner agrees to it, the builder's happy, and then the project hopefully proceeds with very few issues going forward from a design standpoint that could lead to claims. Like I said, that is starting to take hold more and more, and it really is a much more collaborative basis than what design build is. Design build was always thought to be a collaborative basis, but it really never worked out that way in the majority of the projects. The progressive design build really does force a more collaborative effort between all the parties.
Yeah, great points. And we had a podcast, again, with David Hayden on a path forward on his task force, which you were a part of on that as well as a separate podcast with Valerie on Durka to talk about an underwriter's perspective. So we kind of went down on that, but that's good input on the design build and alternative risk, if you will. Also, it's a big reason why we've seen so many changes, if you will, in this particular market, kind of ebbs and flows of capacity. We've seen a real constriction in project-specific capacity. While you might have 20 plus viable insurance carriers willing to offer you a professional liability practice policy for your firm, there might be 5, maybe 7 or so that will offer a project-specific policy. So we've really seen that market constrict. And if you look back, back in the days when I was with that DPIC companies and the great Jack Dorn selling team cover with 20-year policies and adding the general contractor to the policy, the good old days, right, Ryan?
Yeah, exactly.
Things blew up after that a little bit, and we saw the market constrict. Again, Lex and Hayden that comes in with the MVE, material variation endorsement, to try to figure out how to stay committed to that market. And now a lot of these markets have dropped out of this, primarily pointing to the design build infrastructure claims. So to your point, progressive seems to be maybe a necessary solution to try to even make this financially viable for the underwriters. And that's kind of my question to you, Ryan, is that, fortunately, there are carriers like yourself that are still committed to supporting this market, which we need. Why? Why are you doing this, Ryan? I mean, how can you underwrite this profitably? Because at the end of the day, you need to be profitable, don't you? You need to make
Absolutely.
An underwriting profit.
Well, I'll tell you, in just touching base on the constriction of the PSPL market, I mean, you're going to get a lot of answers depending upon who you ask.
Right.
You're going to hear that, the claims were just completely out of hand, which, okay, yes, that's part of it, but that's not the only reason for it. And this is just strictly my opinion. And, people may agree or not agree with me. What I look at from my experience and having gone through that, there were a few reasons that led to the PSPL market constricting and leading it to the state that we're in now. There were many parties to blame. I mean, you had the A&E firms that were signing contracts that were overly, restrictive to their ability to meet things because they wanted to work and they needed the work. You had the contractors that were lowballing, these guaranteed cost projects and eventually and understanding that they were going to use a PSPL policy basically as their piggy bank to make up for the changes. And, and not to be left out of the equation, but us underwriters
Right.
Fell into the trap of we got too complacent. We got large limits, low retentions, and aggressive premiums. And we were putting out these terms for extended periods of time. And, when you put that perfect storm together, you're going to end up that it's going to catch up to you, which it did in 2017, 18, and 19. And, all the markets got hammered badly. And because of that led to a lot of companies saying, well, this can't be done. We've got to get out of here. This is a bad thing. And it was always my opinion that no, it can be done, but we have to go back to basics. We have to go back to basic underwriting.
Right.
And the basic underwriting is going to be, who are the players in this? Who's the design firm? Who's the engineering firm? What's their experience? Do they have a good track record? Do they have a good reputation in the marketplace? What, most importantly, does the contract look like? Are they reasonable terms that an engineering firm and an insurance carrier can live with? And as I said, who's the contractor? What has their experience been like? I mean, there's some great players out there. There's some not so great players out there. And, you have to be aware of that. The same thing with the owners. Are the owners reasonable in their expectations? Are the owners reasonable? They're not going to be coming in with 20 million different design changes because they want the Taj Mahal, but they only want to pay for, a tiny house. So that's what the issue has been. So when I came over to HDI, they had asked, why do you think you can make this work? I said, I hope I can make it work, but if and it's going to be going back to basics. It's going to be going back to, you got to have strong underwriting. You got to have reasonable terms and conditions. You have to have retentions that make sense, and you have to have premiums that make sense. Everybody involved in this process is not a charitable organization. We are all in the business to make money.
Right.
Us, from an insurance company standpoint, our business is to write risk. That's what we go after. We're not a bank that looks to, steer clear of risk. Our business is to look for the risk, try to mitigate the risk, and price the risk accordingly.
And I agree with everything you're saying. I think, again, there is a great deal more underwriting scrutiny that we're seeing now than we had in the not so far off past with this particular product type, right? And as you stated, you're looking at the project types, you're looking at the geographic locations, the quality of those teams, you're getting into those contracts, even those teaming agreements, you're looking at, are there fair and reasonable contingencies and so forth. And as you mentioned, progressive design build seems to be high on your list as well. How do you underwrite when you're looking at the partnerships, the quality of the partnerships? I assume, just given your experience, you kind of maybe know some contractors out there that are more litigious than others, or other professionals on the team. Will you find also that on the design build side, you're running into these DOTs, right? In different states. Are you underwriting that as well? Are you considering the quality of some of these?
Partners? Absolutely. There are certain states where the DOTs are just very, we'll just say, challenging to work with.
Right. And they need to come to the table if they're going to expect to have insurance in the future. Simple as that. They got to
absolutely.
These onerous contracts and flow down provisions and low budget and guaranteed, but that's just not sustainable, is it?
No, it's really not. And the expectations of upper management of the carriers have to understand that in the past, where they were seeing lots of projects coming in with some nice premium dollars coming in. That's not going to be the way it is going forward. You have to, it's not going to be writing 30, 40, 50 projects a year. You may only write 10 or 15 projects a year, but they have to understand that those projects are going to be well underwritten and hopefully well managed, both from the insured side, from the carrier side. We just can't go back to the, to the hazy, crazy days of the mid 2000s that everybody went into. Like I said, it's just a simple matter of taking your eye off the ball that everybody, had that issue. And it happens, it happens in every line of business in insurance that eventually sometime, somewhere, they're going to take their eye off the ball for a while, and then it's going to come back and bite them. It's just the nature of the business. And when I say take your eye off the ball, that's what some people would call a soft market. And when they're getting back to the underwriting basics and putting their eye back on the ball, they call that the hard market. Well, it's not really. It's going back to what underwriting should be, rather than calling it a hard market. It's going back to the basics.
What I try to do through this process here is, try to explain again what are the coverage features and benefits. But again, cost can be prohibitive with this product, and it's going to depend on your project. But at the same time, I think everybody needs to recognize that this is 10 plus years of coverage. So it's usually a big ticket item. Unlike a wrap up, it's not consolidating coverages to try to reduce expense. This is additional coverage, and it's going to come with an additional expense because you're getting, again, coverage for the entire design team, dedicated limits, guaranteed product, as well as joint defense provisions and so forth. And in the absence of a project policy, again, you're going to rely on the limits and the practice limits of the underlying design team. So again, you're going to have to think about what are the cost benefits. And another concern I see out there is that there's another product out there, which is your OPPI. That's the owner protective policy out there, or the CPPI, that's often sold as a cheaper alternative when in fact they're very different types of coverages. Let's talk about pricing a little bit here. I got just kind of back of the envelope, looking at some of this stuff, and we've done project policies for a wide range of projects over the years, from roadways, highways, stadiums, convention centers, hospitals, even high-rise condos. And right now, if you're looking at the cost of this, you are looking at rates on construction values. Again, this is very rough, but could be in the range of $2.50 per $1,000 in construction value to $7, right? Or if you want to break it down, a rate on design fees ranging from $3 per 100 to $10. So a premium for a project-specific policy with a project that's $200-300 million in construction values could run you $300 to $1 million plus, right? But it depends on a lot of factors, as you were going through there in underwriting scrutiny, because I just rattled off a bunch of different project types, Ryan. You're going to price and consider those, aren't you?
Absolutely. And keeping in mind that, so if you're paying, for example, we're just going to throw out, mythical numbers here.
Right.
So say you're paying, $3 million for a $10 million limit of insurance. That $10 million is going to be in place for a 10-year period. Say on that project, say the design team is making $40 million in fees. So we're taking a small percentage of your $40 million. We're taking $3 million of that to give you this peace of mind for a 10-year period.
Right.
And the price isn't going to change. There may be additional premium, but the additional premium isn't going to be millions of dollars. So at the end of the day, say everything goes smoothly, there's no changes, and so you've now paid $3 million for a $10 million limit that's in place for 10 years. The project's done, put to bed. The owner's happy, the contractor's happy, and you're happy, and you don't have to worry about anything coming up down the road that you might not have expected that's going to hit your practice policy, that may affect the cost of your practice policy next year because of a claim on this project.
You need to get that application in as soon as you can, and it's not hard to do. There's shorter apps, and you get a lot of to be determines on those apps because you're often early in the process, right? But as far as who's the contractor, even, or some of all the subs, you're able to come up with at least an indication, aren't you, with just some of the general specifics around construction value, project type, and so on.
Oh, absolutely. Yeah. There's very few project types that we haven't seen. What's going to be constructed, as we're expecting to be seen over the next few years, there's going to be a lot of infrastructure projects. Because as we all know, the infrastructure within the U.S. is not standing up very well. So there's going to be a lot of street and road, a lot of highways, some tunnels. All those projects, we've all seen before. We all know what the potential issues are with those. So even if we get the application in with a lot of TBDs, if we know that you're going to be constructing a highway and say you're going to be constructing it, in New York State, we know that New York State is a challenge. We know highways are a challenge. So we know how to price it, or ballpark the pricing up accordingly as compared to if you were constructing a highway, say, in Nebraska, where you're not going to have quite the traffic flow.
I got one for you here, Ryan. Right now, I'd like to get a live quote from you here. So it's rental, not condo. It is high rise, and it's in San Francisco, and it's $800 million in construction value. And we only need $10 million in PL coverage. You interested in this? What are your thoughts on this one?
To be honest with you, no, I would probably decline that. I'll give you my reason why I would decline it. One is the area, San Francisco, right now is a bit of a challenging area. Two, even though they may start out as rentals, what we would look for and what I would like to request is that we put in writing, or at least put on the policy, what we would call a condominium conversion exclusion. That a lot of times the project owners won't accept that.
Right.
And that's only because we understand that with the current housing situation, housing prices being what they are, it's a challenge. And we've seen where a lot of these luxury apartments will go down the road and they convert over to condos because it's much more lucrative for the developer to convert them over that way. That's how I would look at it. But if I were to try to underwrite this and give you a price, it would be quite substantial.
So this would be a short call with you, I know. In fact,
yes.
You already declined it, Ryan. So we went to 7 markets recently, and of the 7, only 1 offered an indication subject to a lot more information, and they would only offer $5 million. So we only got 5 of the 10 we needed, and that $5 million limit was going to go for a $3 million premium with a $2 million SIR.
Yeah. I know.
So obviously something like this is not commercially viable. So this creates a real dilemma, though, for the design professional. And just get off a tangent a little bit here, but the fact that if it's not commercially viable or you can't get insurance for it because it's not available, you have a dilemma because the design professional may still find that this is a great project. This is a great opportunity. However, what are you going to do if you're going to go forward and the market has spoken, so to speak, saying that this is a very risky project where we're not going to place our bet on this? And so the design professional, if you are going to go forward with this, they really have to have some serious go, no-go considerations if they're going to go forward at all. And that contract really needs to be well thought out, right? And
Exactly.
You want limitation liability, waiver, consequential damages, a condo rider regarding maintenance, and so on, right?
And keep in mind that when they're putting that project now, they're blending that project into their overall practice. So It's not going to be a standalone. Whereas in a project policy, this project is standing all by itself, and this is what has to be underwritten, which makes it so unattractive. But if you blend it into your overall mix of business that you do, it doesn't stand out.
Right. That's an interesting real example there. And what happens when these markets constrict, projects that would have gone to a project policy are now going to fall down to the practice policies, which will impact the market, sooner or later, if there's not that coverage out there. How do you see, on the future of project-specific market going forward?
Well, again, I think seeing that the markets are starting to go back into, the basics, I can tell you that one of the things that I'm doing, and I've had some discussions with people that I've worked with in the past, and still work with and interact with. One of the things that I'm doing, that I'm putting together, is trying to bring, when you look at how Lloyd's does business, Lloyd's brings a bunch of carriers together and lets them take a percentage of an overall limit on a risk.
A subscription
Which
placement
makes it much more attractive to the carriers, rather than one carrier putting out, 5, 10, or $15 million on a project. If we can get a group of carriers together and say each of them putting up, 5 million, 2.5, or whatever, to build it up to a $20 million program, it makes the PSPL market much more viable, in my opinion. So I'm actually working with a few other carriers now to put such a syndicate together here in the U.S. We're hoping to have it ready for launch within the next 2 months. And what we've decided is, again, we look at this and say, okay, couple benefits to it. One, if you get 4 or 5 carriers together, they can each put in $5 million on a project. That gives us a $20 million primary program. A $20 million primary program involved in a claim is going to have much better clout than a firm with only a $5 or even a $10 million limit out there, and then says, okay, now you've got to rely on your patchwork of excess carriers to come and make up the difference. Our thought process is, by having that larger primary capability, it will help in the claims. It should help in getting together the capacity that's needed for these projects. And it also allows the carriers, to be able to put in a smaller amount of limit in than what they would have done before, but still get, a reasonable return on it.
Right.
So, like I said, it's something I've been thinking about, talking to people about for the last few years, and now have the opportunity to do it, and been working on this for the last year, and hopefully it looks like it's coming to some fruition, and hopefully, like I said, another 2 or 3 months you'll be hearing some more about it. But we're very excited about this capability.
Well, that's great. I think, again, it'll benefit the market to have this capacity coming back into the marketplace for this product. That's for sure.
Just because we have this doesn't mean we're going to be, the crazy hazy days of, low retentions and, low dollars. I mean, our retentions will be, we know we're going to be looking at, larger projects greater than, say, $750 million for this. But the retentions are going to reflect what the risks are, and the pricing is going to reflect what the risks are. But we're going to have a strong program manager in place. We're going to have, which is going to help with the pre-claims issues. Program manager, it's going to be Donovan Hayden. And, David Hayden has been instrumental in helping guide us through what we think the market needs, and what he sees, what the market needs, and what he hears, and talking to his own clients. So we really hope that we're going to be able to bring a balanced approach.
Look forward to hearing some more about it. So when discussing project-specific insurance, you need to be aware also, as an insured or design professional certainly out there, of another product which is referred to, and I mentioned this earlier, OPPI or CPPI. OPPI is Owner's Protective Professional Indemnity Policy, OPPI. It's a first-party indemnity policy that lists the project owner as the named insured, and the policy sits excess over all directly contracted firms' annual practice professional policies, or maybe the prime, but it's sitting over and essentially laying out the practice policies of the design professional, prime, or team, depending on how this is written, as essentially the deductible, if you will, the first layer of that coverage. The cost of an OPPI or CPPI can be substantially less than a project-specific policy, so substantially less than a PSPL. However, there's a good reason for this, given these coverages are very different products. A concern that I always have is that an OPPI is sometimes sold by some brokers as a less expensive alternative to PSPL, when in fact they are entirely different coverages that you need to be aware of. The problem for the design professional is that an OPPI offers no coverage to the design team. It's only for the owner, and can potentially expose, and it will expose, the PL practice policy of the prime and possibly other members of the design team. and as that first layer of coverage prior to the OPPI being triggered. This can create an adversarial situation, and the parties need to be talking about this, I think, and be transparent, ideally, about this. And so while an OPPI and a CPPI can make a lot of sense for some owners on big projects, but again, from a design professional's perspective, as advocates for the design community, it's not going to offer any coverage, and you need to be thinking about this. Now, we've had some success with a hybrid approach of combining a PSPL with an OPPI, where we would place that PSPL, that project-specific policy, as that primary layer and then attach the OPPI. And to really make this work, you want a limitation liability. So you trigger that OPPI to the proceeds of that project policy, taking full advantage again of that joint defense provision. So kind of where you were going there, that's another hybrid. And I know you and I have talked about this too in the past, Ryan, but it's good to see kind of, a lay of the land, if you will, and where this is kind of hopefully evolving, right?
Absolutely. And I've seen where they have brought in the CPPI or the OPPI to set excess over a PSPL. And one of the things that some owners and contractors don't understand is the reason why it's so cheap is because they're mandating that the engineering firms carry, say, a $5 or $10 million limit of liability. And so that has to be eroded before either one of those coverages will come into place. So when you're looking at a $10 million retention under an OPPI versus, say, $1 million retention on a PSPL, the pricing differences, of course, are going to be different because you've got $9 million in leeway there.
Right. Well, we're going to have a separate conversation just on OPPI and CPPIs. I think it is important enough for certainly design professionals to understand that product. But Ryan, this has been great. It has been a deep dive. But before I let you go, any parting words of wisdom on our topic today?
No, again, thank you very much, Dan. I appreciate the platform. And again, look forward to working with you and your insureds. And remember, underwriting is going back to basics. So we're putting our eye back on the ball, and it's only to benefit you. It's going to benefit you as much as it's going to benefit us by being able to continue to offer you PSPL coverage for these jobs when you need them.
Yeah, I agree. And I think it's important that you've committed to this, and you're still in place and supporting us with this valuable coverage. So I want to thank you, Ryan, for your time and sharing with us your experience and expertise on this topic on insuring single projects.
Thank you.
So we dumped a lot of info on you on this topic, and we will be including a technical brief on insuring single projects that Willis A&E has, and we'll include it along with this podcast. So thank you for joining us for another episode of Talk to Me About A&E. Be sure to check out our website at www.wtwae.com and visit our education center for a full list and links to all of our Willis A&E podcasts, as well as some of our technical briefs and on-demand programs. I'm Dan Buelow, and I will talk to you soon.
Thank you for joining us for this WTW podcast featuring the latest thinking on the intersection of people, capital, and risk. For more information on Willis A&E and our educational programs, visit willisae.com. WTW hopes you found the general information provided in this podcast informative and helpful. The information contained herein is not intended to constitute legal or other professional advice and should not be relied upon in lieu of consultation with your own legal advisors. In the event you would like more information regarding your insurance coverage, please do not hesitate to reach out to us. In North America, WTW offers insurance products through licensed entities, including Willis Towers Watson Northeast Incorporated in the United States and Willis Canada Incorporated in Canada.